What's up, everyone? It's Caddy with Money Vesting, and it is raining cash. It is literally cash is falling from the heavens to some of these biggest banks, and the reports are out, at least the first ones, and it's been reported that Bank of America has seen close to $15 billion of cash inflows as deposits in the last few days amid the SVB fallout, Silicon Valley fallout. So we're going to talk about Bank of America, and I'm also going to be talking about XLF in this video and why I do believe that there is opportunity there, considering how much it's selling off. There is that, contagion effect that even though regional banks are the ones that actually got affected in this entire sort of debacle, especially when it comes to some of the smaller medium banks that don't have any capital reserve requirements. Silicon Valley Bank to begin with, of course, kind of kickstarted us off with this contagion, and then Signature Bank followed, First Republic Bank followed, Silvergate followed. We also had, companies like Ally Bank are kind of in a very stressful situation. One of the things that we made sure of, and I mentioned this in my previous videos, is that there is going to be a shift in liquidity. And there's only two places where liquidity can really be going. Number one is the treasury market, right? So customers and companies buying bonds and treasuries and kind of parking cash, building bond ladders, and whatever the case might be, building short-term treasuries or buying T-bills in order to protect their capital because it's backed by the full faith and credit of the United States government. And the second place where the liquidity can flow to is the big banks, right? The consolidation of these big four that are considered as GSIBs, right? GSIBs, those are your systemically important banks, or SIFIs, SIFI. I can never get the pronunciation right. Is it SIFI? Is it SIFI? But SIFI is systemically important financial institution. They can be used interchangeably, but I also shared a list in my previous videos going over which are the banks that are considered GSIBs as of November 2022. And I also went over the reserve requirements and the stress test for these banks and why they are a much better proposition compared to regional banks. So as the liquidity shifts, there is definitely a lot of potential with some of the bigger banks and some of the systemically important banks. So too big to fail banks are benefiting from deposit outflows from regional banks. The closure of 3 U.S. banks in the space of a week has led to an influx of free cash and fresh cash for Wall Street's big institutions, with Bank of America reportedly raking in $15 billion in customer deposits recently. And we've also learned that other banks, including Wells Fargo and Citigroup, have also seen billions of new customer deposits and money flowing into these institutions, but these institutions are yet to divulge that information. And this right here is going to be the list of GSIBs. So it's, again, the systemically important banks. And right now you'll notice that JP Morgan at the top of the list. I'm sure they've also seen a lot of inflows. Bank of America is the second on the list. And we got Citi, we got HSBC, Wells Fargo is going to be all the way down here, but they are part of that list. We got UBS, we've got Societe Generale, Santander, Morgan Stanley, a lot of United States Bank, a lot of other banks as well. And you'll notice Credit Suisse is on that list, which is why there's such a desperation to not let that bank fail. Swiss National Bank, obviously loaned them another 53 billion US dollars, or 50 billion Swiss francs. We already know that Saudi National Bank has, bought a 9.9% stake and had that cash injection 3 months ago. So everyone's doing everything in their power to make sure that Credit Suisse does not fall because of the fact that it is part of the GSIB. And of course, it is, systemically important bank, one of the big banks in Europe. But that being said, this right here is going to be the stress test from 2023. Now, Bank of America does not score too well on this stress test. Neither does JP Morgan, neither does Goldman Sachs, neither does Wells Fargo. But that's as a result, their reserve requirements are slightly higher than compared to some of the other banks. But as you'll notice, Bank of America checks on all 3 ends, meaning that it is subject to a global stock market shock. It is subject to exploratory market shock. It is subject to counterparty default. So those are the stress tests the Federal Reserve conducts on a regular basis to make sure the financial system is stable, it's liquid, it's capitalized, and we're not open or blindsided by any risks. But of course, a lot of these companies don't pass the stress test very often. In fact, Bank of America released a press release, and JP Morgan Jamie Dimon also was furious with the stress test from the Federal Reserve conducted. I think that report came out back in October. I talked about it in my previous video as well. Citigroup also does not score too well on this list because it's got the check on all three ends. Same thing with JP Morgan, same thing with Morgan Stanley, same thing with Goldman Sachs, all three accounts. And then this right here is going to be State Street Corporation. They are not subject to a global market shock, but the other two they are, and Wells Fargo is again subject to all three types of default or shocks or risks, so to speak. Now, that's one of the reasons why we do have the requirement, the capital requirement for these companies. And again, capital requirement, think of it as the equity and the shareholders' equity and what the company has with respect to its assets that they currently have lent out, right? Assets can be loans that they have lent out, investments that they've made, right? Anything that they are generating money is going to be considered an asset for them, and they have to at least maintain equity of about 7 to 10 to 11% depending on the bank that we're working with. And Bank of America, you'll notice, is currently at 10.4%, which is on the higher side of compared to some of the other banks out there. Minimum capital ratio is 4.5%. But then, of course, we've got that surcharge for this company and stress capital buffer requirement because they were not able to pass the stress test, and the surcharge as well. Again, you'll notice Ally Bank does not have that because it is another smaller bank. So it doesn't have that surcharge, and its capital buffer is also a little bit lower than that of Bank of America, 3.4%, because again, Bank of America has to go through that stress test, and it also has, it's also considered as an SIB or systemically important bank. Same thing with JP Morgan. If you come down the list, this right here, and that they've got a 12% capital ratio requirement. Goldman Sachs is going to be somewhere around here. Citigroup is actually over here at 11.5%. Credit Suisse really high at 13.5%. And if you go down the list, we got Morgan Stanley at 13.3. We've got Wells Fargo at 9.2. And then let's see, Goldman Sachs, can't seem to find them right now. But you get the idea, right? Their stress test, they're not passing it. They're systemically important banks, though, so their capital requirements are much, much higher at the moment. So if you go over to how Bank of America is doing, and the valuation is really, really cheap for a 3% dividend yielding stock. It's a little over 3%. And the thing is that once $15 billion starts to come in, right, that's how much deposit inflows you're seeing. Considering how yields are so high right now, they can actually take advantage of that, right? They can lend it out, or they can invest that into short-term treasuries. They're not going to be going through the same problem that Silicon Valley Bank did, say 2 years ago, because there was nothing to invest in because the yields were so low, mortgage activity was not that high. A lot of companies were not financing through debt; they were raising equity because the market was so hot. So it was a pretty much a game of searching for yield. That's what it was, right? Back in Silicon Valley Bank days, that's what they were doing. That's why they had to overreach for yield by going after long duration bonds, which is mortgage-backed securities. With Bank of America, with JP Morgan, some of the larger institutions right now, deposits coming in, that's not a problem because yields are higher. They can go after 3-month, 2-month, 1-month treasury notes, treasury bills, so to speak, and they can actually get access to higher yielding, making sure that spread's good and their net interest margin is also pretty relatively stable at around 2%, 2.5%. Now, considering the valuation for Bank of America, right now it's trading below its book value. It's at 0.94. In other words, below its assets versus liabilities. Net worth pretty much is below 1 right now. The market value is below its actual net worth, so to speak, in a more logical sense. And price to sales trading at 2, price to earnings at over 9, and price to cash flows at under 3. So valuation is definitely very, very cheap for Bank of America. It has fallen off quite a bit from $45 down a little bit over 42%, but it is still higher from its March 2020 pandemic lows. In fact, we're closing in on the 3-year anniversary for COVID March 2020 sell-off. It happened back in March 19th, so just about 2 more days. But I do believe that Bank of America definitely does represent some opportunities here, especially when you consider these amount of inflows, right? And it's not just for Bank of America. I also do think JP Morgan coming down to pretty aggressive levels here, watching 125 as a support. And that's one of the reasons why I am more interested in XLF, because it kind of takes that risk off a little bit, right? You're not betting on just one bank, right? Bank of America or JP Morgan. That's why I'm kind of more inclined towards XLF at around $29.50, closer to $30, because number one, it is oversold, incredibly oversold. The technicals are just very, very exciting, and they look very good for a potential bounce here. And we've got a 2% dividend yield that you can lock in at your yield to cost, considering where you buy it. And not to mention the valuations have come down for a lot of these companies. As I just mentioned, price to book ratio is now under 1 for Bank of America. For JP Morgan, it's a little bit higher, 1.4. And personally, like I would love to just like lock in that yield and take advantage of that oversold bounce from a technical basis for XLF or even FAS as well. So that's what I'm really paying attention to. Again, this contagion might go on for a few more days. We'll see how banks trade over the next couple days and kind of closing out this week, because again, Credit Suisse kind of sparked that fear once again among bank stocks. But I do think if you are looking at some of the larger institutions, the amount of deposits they're taking in and the fact that they are considered SIBs and they've got higher capital reserve ratios, so not really going through that whole process of not having enough liquidity, I do think that there is going to be an opportunity. And once this fear is kind of subsided, once the dust settles, so to speak, I do think there will be opportunities considering how oversold they become and the valuations also come down pretty dramatically. So let me know in the comment section down below, what do you think? I'm watching for 29.50 for XLF. That's the level that I would really be paying attention to if it comes down, because we have bounced off that level a couple times, and that's a previous resistance. And again, we would continue to be very, very oversold. I would also be looking at some cash secured puts on XLF or FAS. We'll kind of alert everybody in our Discord once I actually go through with it. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like, subscribe to the channel. Let me know down in the comment section below, what do you think about the banking sector right now? And I'm talking larger banks, especially SIBs, right? Systemically important banks, larger institutions. As always, happy investing. I'll see you all in the next video.